It's official, Germany's economy has contracted. When it went down earlier, I wasn't entirely convinced it wouldn't just be a one-off blip, but this bad news 2 quarters later shows that this is a more permanent long-term trend. The economy contracted 0.1% in the last quarter, which is the third quarter with no growth in a year. So I have this article from BBC News talking about what's happening. German economy slips back into negative growth. Germany's economy shrank during the April to June period of last year. A decline in exports dampened growth, according to official data, which comes amid concerns of a global slowdown. Gross domestic product fell by 0.1% compared with the previous quarter, according to the Federal Statistics Office. It takes the annual growth rate down to 0.4%. Germany's largest economy narrowly avoided recession last year. If you add up the growth rate for all Germany's 4 previous quarters, 0.2% plus 0.1% is negative 0.3, that's 0.4. They only add up to 0.1%, so it's interesting how the official annualized figure is 0.4%. Maybe they're counting some growth from the quarter before that to get the 4% number. But I mean, you could look at it and say Germany's doing even worse if you just add up the quarters straight up. Early signs for the third quarter look ominous, said Andrew Cunningham, chief Europe economist at Capital Economics. Manufacturing business surveys for July were all gloomy, and while the services sector should continue to hold up better, there are some signs that the slump is spreading to the labor market. While the overall figures were negative, household and government expenditure increased, as did investment outside the construction sector. Construction itself fell after an unusually good first 3 months, bolstered by a mild winter. The development of foreign trade slowed down economic growth because exports recorded a stronger quarter-on-quarter decrease than imports, the Statistics Office said. The US-China trade war and the UK's departure from the EU, especially if it happens without a deal, are among factors affecting global economic confidence. Last month, the International Monetary Fund cut its growth forecast for the global economy for this year and next, citing US-China tariffs, US tariffs, and no-deal Brexit. China's own economic slowdown has weakened demand for foreign goods. It's an important market for Germany since it buys plenty of luxury cars. Yeah, but of course, most Chinese cars are made in China. I mean, they may be made by foreign companies and branded with like a Volkswagen or whatever, but they are mostly made in China, so only a small portion of the cars in China are actually imported from foreign countries. The results may make authorities consider more monetary stimulus, said Neil Wilson, chief market analyst for Markets.com. Meanwhile, the European Central Bank has hinted it could cut interest rates to tackle a slowdown in the Eurozone economy. Of course, interest rates are already negative, and while there might be a little room below the zero lower bound to make them even more negative, because it does take transaction costs and fees to actually hold on to money, I think they're already at that point, and any more negative interest rates be a lot more burdensome than just paying whatever holding costs are to keep hold of real currency. The ECB said last month that a weak manufacturing sector and uncertainty over Brexit and trade threaten to the real growth. It forecasts rates at a current or lower levels until mid-2020. I pulled up this other feed from The Guardian, and Germany's economy shrinks, fueling fears of recession. Business Live. German GDP shrank by 0.1% in April-June. Exports have fallen as trade war bites. Germany has only grown by 0.4% over last year. So Matthias Weber, economist at the University of St. Gallen, argues firmly that Germany should increase government spending to secure growth, especially as borrowing costs are low. Yeah, there's a good case for that. Okay, government bond prices have jumped to fresh record highs this morning, driving down the yield, or interest rate, on the debt to new record lows. Germany's 10-year Bund has now hit minus 0.6%, the lowest ever, meaning traders are paying more than the face value of the bonds. That means investors anticipate low growth and weak inflation. They're looking for somewhere safe to park their money. Germany would have no problem borrowing to invest in new infrastructure to spur growth. Strategist Andreas Strana Larsen of Nordea Markets said Germany's woes aren't a surprise given all the grim economic data recently. It always surprises me how everyone gets surprised by recessions. It's been pretty clear for a while that Germany was on the brink of a recession. Just look at the PMIs, Santec Survey, or IFO. I mean, the PMIs they give you a vague idea of what's happening, but they're not the final word, and sometimes they're off from what's happening. Like, you see, in this period, the PMI were, really low, but the Eurozone growth wasn't nearly as bad, so, they're not the complete be-all and end-all. And, of course, there was also this blip here where the PMIs were really low, but the economy just kept humming along. You have to actually wait till you hear the hard numbers for the quarter growth before you really know what's going on. Okay. Outlook for quarter 3 is extremely subdued, with industry likely headed for another contraction and exports unlikely to see much joy amidst weak global trade. Domestic demand should hold on, but will continue to struggle to fully compensate. So, ING, end of a golden decade for Germany. Today's GDP report marks the end of a golden decade for German economy, says Carsten Bredsky, chief economist for Germany at Dutch Bank ING. I think I completely mispronounced that. So, Bredsky sounds deeply disappointed to learn that German economy contracted by 0.1% last quarter. He blames damaging uncertainty caused by Trump's trade war with China, along with problems at Germany's car makers, writing, "Trade conflicts, global uncertainty, and the struggling automotive sector have finally brought the German economy down on its knee. In particular, increased uncertainty, rather than direct efforts from the trade conflicts, have dented sentiment and hence economic activity." Brexit points out that Germany has had a decent run since the financial crisis, not anymore. It was a decade of strong growth on the back of earlier structural reforms, stimulus, globalization at its peak, and steroids provided by the ECB in the form of low interest rates and a relatively weak euro. This decade, in which strong German growth looks so effortless, is coming to an end. Okay, I think that's enough looking into that newsfeed from The Guardian. So, I think you basically get the picture. Germany's economy is contracted. Since this follows a series of bad news, we know that this contraction is like a more permanent long-term trend rather than just a one-off blip. So Germany's economy is now doing really, really badly because its economy relies on exports, and that source of growth is being cut off because China's economy is just not doing as well, and they're simply not importing as much. So, for all these years, Germany whacked its finger at its neighbor European economies, but it turns out it's not so different from them once you take away its exports. And it just has to run its economy by itself, like its neighboring countries elsewhere in Europe, like France and Italy. Please share this video with anyone you think might be interested. Like this video, leave your thoughts in the comments, and subscribe and hit the notification bell.